Hello and welcome to another no-nonsense survival economics video. Now, last year, the last video I made on survival economics series, I was talking about an event that I was really concerned that might happen. Well, guess what? That event just happened. Instead of it happening last year, the event happened this year. The Chinese yuan was accepted into the SDR basket, and they are gold backing their currency, and it will be official October the 16th unless something drastic happens between now and then. Okay? And I was really concerned about that, and I am concerned about it now for your sake, even more so than mine. And the reason why I'm concerned is because of the dollar status as world's reserve currency. Okay? Now, so I wanted to lead off with that because if you watched the last one and now you're getting to this one, you're going to say, well, what happened to that event he was talking about, that thing he was concerned about? Well, it's been postponed for 1 year from the time that it was supposed to happen last year. And there's one main reason why it was postponed. But now that the Shanghai Gold Exchange opened on April the 19th, and the Chinese have decoupled their currency from the dollar, and they're going into the SDR basket as a reserve currency according to the IMF, International Monetary Fund. The danger is at hand. Okay? The danger is at hand. Now, what I will do in the comment section, I will link to videos of people who are barking up the right tree. And I emphasize barking up the right tree on the issue at hand. Okay? And that is about the Chinese yuan gold backing, decoupling from the dollar, and going into the SDR basket, becoming a reserve currency, an international reserve currency, and positioning itself to replace the dollar as the number one world's reserve currency. That is a major concern. And I talked about the monetary system that we have in a previous video. And if you remember what I said, now it should be kicking in for you right now about why that's so serious. Okay? This video is not about that. It's about the stock market and getting a better understanding of how it actually fits in the jigsaw puzzle when you're looking at the economy. I'm trying to overcome an objection here. The objection is that, oh, well, I don't really believe that I really need to prepare for any type of economic calamity that these people are talking about. Because I look at the stock market and I say, well, it's doing pretty good. It's more than double what it was when the economy collapsed, like just after the economy collapsed the last time. So, and that was, survivable even then. Okay, so let's first understand what the stock market is and what stocks are. The stock market gives you an overall indication when you look at like the major indices, the index like the Dow Jones Industrial Average and the S&P 500, right? So I'm just going to stick with those two because those are the most common ones. There are others, but this isn't a class So let's just say Dow Jones. Let's just stick with Dow Jones Industrial Average, because that's what most people are going to look at. Oh, because when they say, oh, the stock market's over at 17,000, that's really incorrect. It's the Dow Jones Industrial Average, okay? And I'm not going to get into the details about what that means, but that's what people look for. They look at that number, okay? Now, that number, could be, 15,000 something a couple months ago, 17,000 this month, 6,000 next month. 16,000 next month, not 6,000. I hope not. It's possible. That would be a crash. But 16,000 next month, or whatever it may be. And some people are calling for 6,000. But that is an overall indication in general of the direction that stocks are heading in at a particular time. Okay, so that's overall. Okay, and so then you have to look at, do you own any particular stocks? Okay, now what is stock? Stock is ownership. So ownership, that's really what you're saying when you say you own stock. So do you own any companies? Do you own McDonald's? Do you own Coca-Cola? Do you own Microsoft? Okay, just to name a few. And if you own these companies, then in a literal sense, then when you look at stock prices and you look at the Dow Jones Industrial Average and things like that, then you should be concerned. Okay, one of those companies is in the NASDAQ, and then you have the other companies that are in the New York Stock Exchange. Okay. So when you look at these exchanges and you look at these indexes, and you see these things, and you can be concerned. If overall it's going down, then you're going to be concerned about your individual ownership. If it's going up, then you're going to be less concerned about your own individual ownership. Now, if there are 100 shares of stock in a company and you own 10 of them, then you own 10% of the company. If you own 50 of them, then you own 50% of the company. In reality, if you own 100 shares of any company that is on the stock market, you probably own something like 0.001234%, something like that, okay, of the company. But I'm just trying to give you a good perspective here of what stock ownership means. Now, every owner of a company gets to vote for the board of directors, and the board of directors gets elected, and they serve a term, okay? And that term is usually annual, or certain members get a contract to be on the board of directors for a certain number of years, and they are employed by the corporation that you own. And when you vote, you help determine who holds those positions on the board of directors. So what do you think the primary objective of Coca-Cola is? Let's be real. The first thing that came to your mind was sell sodas, soft drinks. That's the first thing that came to your mind. We know that, right? Now, of course, there are a few of you who know the real truth, but overall, that's what you were thinking, right? And so now you're starting to wonder, because I'm going to say, what is the primary objective of McDonald's? Regardless of what I just said earlier, you thought selling hamburgers, right? Selling food, something along those lines. That's what you thought. But see, you would be wrong either way. Now, on the other hand, take something like Microsoft, company like Microsoft, you would say, what is their number one objective? And it has to be none. Now, it has to be the software. What about the Xboxes? Nope, not the Xboxes either. It's not the software. The number one objective of every one of those corporations, and every one of them on the New York Stock Exchange and on the NASDAQ, is to please the shareholders. And nothing pleases the shareholders like increasing stock prices and dividends. Yes, dividends. Those things that come as a check in the mail saying this company has earned revenue and is sharing a part of that revenue with its owners in the form of cash money. That's a dividend. And stock prices, meaning going from $100 a share to $200 a share to $500 to $1,000. And as long as you see dividends and you see stock prices going up, you're going to continue to vote for the same people on the board of directors. Now, who runs the company? The board of directors. You might be an owner, but the board of directors runs that company on a daily basis. So the company's objective is set by the board of directors, and it is to please you if you're a shareholder. Now, if you're not a shareholder, okay, which I dare say the majority of Americans are not a shareholder in anything, okay, then it does not matter what the stock prices are, what the Dow Jones Industrial Average is, because at the end of the day, that is not going to put food on your table. That is not going to pay your bills. That is not going to employ you. And let me explain this to you. Because pleasing shareholders may not include hiring you. In fact, it may include firing you, closing down the plant that you work at, closing down the store that you work at. Like Walmart closed 269 stores. It may include closing the store that you work at. I forgot how many Sears and Kmart are closing. It may include closing the Sears that you work at. Because if closing the Sears that you work at is going to result in better revenue, listen now, net revenue for the company, it's going to improve the stock price and it's going to please the shareholder. And you, the employee, are fired. You got fired to please the shareholders. And that is something you have to understand. Comprehend this. Rather, you are not a shareholder, so stop paying attention so much to the stock market. Is it a factor? Is it an indicator of anything? Yes. I'm not saying it's not important. It's not as important as most people think it is, because the stock market is going to bounce back one way or the other because they are in business to please shareholders. So if the economy goes down and they are cutting jobs and moving plants overseas and moving offices overseas, moving customer service to the Philippines, moving everything out of your state, out of your city, out of your country to improve net revenues, their stocks are going to go up while jobs in America go down, while incomes in America go down. It doesn't matter. It's all about the shareholders. It's not about you. It's not about your next door neighbor who needs a job. It's not about anything but pleasing shareholders. So it doesn't matter whether the economy goes up or the economy goes down. If the stock market goes down, you know what the boards of directors are going to do? They're going to make adjustments. Usually, the stock market indicators go down or point down because of what? Poor consumer spending, a lack of consumer confidence. You see, housing starts fall. Okay, you see property prices fall. All these are factors, okay, that weigh on the market. Okay, so when they see, okay, people are spending less money, when they see inventory to sales ratios being too high, then they start to make moves. See, so when the stock prices drop, they're going to do whatever it takes. If it goes down to firing half the employees, closing half the facilities, 75%, liquidating everything, getting down to the bare bones of what they need to do to make a profit, to get that stock price where it needs to be, then companies will do that. They will get rid of 75% of their employees if they have to. It does not matter. And it doesn't matter what you think. And it doesn't matter what a politician has to say. It doesn't matter what people complain about in the media. It doesn't matter. You can protest. You can scream at the top of your lungs, carry signs up and down Wall Street, block traffic. They are going to please the shareholders, period. So just because you look at the stock market and you look at the Dow Jones Industrial Average and you see, oh, look at it. The economy must be doing great. It's doing well. Look at the price. Look at the value. Oh, no, that's not value. It's not. Okay? It's overpriced right now. And it can collapse. It needs to correct. It needs a serious correction. But no, you look at it and say, oh, it's over 17,000. Everything's going great. No. Because the U3 unemployment rate is 5%, but the U6, which is a better actual unemployment rate, is 10%. And that means real unemployment is probably more like 20%. If you exclude maybe 10% who are not working, that may be actually retired, literally really don't want a job, okay? Because the workforce participation rate, which means able-bodied American workers working, is just right at 70%, just under 70%. So basically, you could say 30% of Americans who are capable of working are not working. But yet we have an unemployment rate of 5%. Okay. Yeah, that makes a lot of sense, doesn't it? No. Housing starts are down. Incomes are down. Average incomes are down. Consumer spending is down. Inventory to sales ratios are ridiculous. The Baltic Dry Index is low. That's the cost of moving goods. And why is that important? Because everything is based on supply and demand. The only reason why the price can be at record lows is because the demand is at record low. If demand is at record low, that means that consumer spending has to be low. And whenever consumer spending is low, that's bad for corporations. Now, so anyway, understand what corporations do. They please shareholders, not people. Do not look at the stock market and say everything is great because the stock market is looking good. The Dow is high. No. The Dow can be high and the economy outside of Wall Street can be low. Okay? 95% of income gains during this entire presidential administration and this whole recovery have gone to the top 1%. And what do the top 1% do? They own stocks. 95% of income gains in America have gone to the top 1% over this past 7 years. How do you think that happened? Because corporations that the top 1% own figured out how to thrive in the poor economic conditions, and they will do it every single time, and they will bounce back, and they will build those stock prices right back up. And that does not do anything for the 30% of able-bodied American people who aren't working. And let's just say 10% of those are retirees. That means 20% of Americans are unemployed. Period. 20%. Not counting children. 20% unemployment. That's the real number. You go look it up. You go look up the labor force participation rate. You go look it up. You go look up the U6 unemployment and the U3 unemployment and learn the difference. The only unemployment rate they talk about is the U3. So no, the economy is not doing as good as the leading politicians want you to think it is. It is not. It is hanging on by a thread, but the rich are getting richer. So I say that for those of you who are looking at the stock market and you're looking at the Dow Jones Industrial Average and you're saying, well, things aren't looking so bad to me. They're bad. Okay? Don't look at the stock price and think that what Wall Street is doing, if it's looking good, then it's looking good for Main Street. That is not true. It is not. And that's the end of this video. Thanks for watching. Like and subscribe for notification of future videos.